Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Doug Agrin. Hey, Doug.
How you doing, Kirk? How's everybody else doing out there?
Everyone's doing great. Everyone's in a good mood. Everyone's happy. Everyone's making money. Oh, wait a minute. Oh, wait. That's the wrong week. Sorry. Yeah, it's been interesting. It's funny. I have to point this out. Some of the little behind the scenes stuff that listeners may not care about, but I find them comical. Is I set up the audio viewers, you're not going to understand this, but those of you who are watching this live on YouTube or X or Facebook, you're going to see this. So we put out these posts a week in advance. So after the show, I actually schedule next week, and I have to come up with a title, and I can't change the title. It's just coming up with a title. And so many times I put a title for like the prior week's content because I don't know what I'm going to talk about the following week. And this week, the title is The Big Move in the S&P 500. Hold on. What was the actual thing? It's
Big move in the S&P 500 is coming.
Is coming, yes. So
sure is.
Yeah, and I guess it's perfectly timed. We were 2 days late, but actually I give myself credit there. What they call it, snaps, or the old days when I was in college, like girls would say that. Anyway.
Oh, snap! Oh, yeah.
The
boy,
snaps.
You're really going back a few years.
That's like 20. I'm old.
Yeah. No Gen Z's watching; they wouldn't follow anything you just said.
Yeah, I'm officially half a century old, so But anyway, so we had this thing, and of course, obviously, I was not planning it based on the tariffs. I didn't think it would be that big of a deal, but apparently it is. If anyone's not paying attention, please go back to sleep and don't watch the news because it'll scare the pants off you. But yeah, I mean, the last few days have been a little scary for people since Liberation Day. I don't know if that's liberation from the rest of the world or their liberation from us, but either way,
I think it might be liberation from your money.
Yes, liberation from your money is what's going on. But frankly, here's something I want to convey to people, and we're going to talk a lot about what's happened and what's going on. But I want to convey this to people. We've been talking about this for the last few weeks in the show. There's no secret that the markets are extremely overvalued. They have been for a long time. We talked about it last week and the week before. If the S&P dropped 50%, it would be historically a normal valuation. 50%. It was a 34%. It was a 34 PE. 17 is average. Historically average, 17. It's not even cheap. That's just the average. Cheap was like, I think went down to like 6 or 8 or something like that. But that was like the low in the 70s. But if you think about it, like if you just think, well, it'll just keep going higher. I don't know what's going to happen, but I'm going to make a prediction here. And I don't make predictions on the show because we're all bad at predictions and they frequently are wrong. But, the markets have been selling off pretty hard in the last few days. Today, it looks like we've kind of hit a support structure here, so it might not go any lower today. But
you can't get a support structure any lower than the bottom of your foundation. So
that's true. Yeah. Well, I guess you could dig a lower foundation, but yeah, the way that things are working right now, I would say the thing to note is this. It's Friday. What's going to happen? And I'm just kind of talking through investor psychology about how things work. Every single time this happens is different, but lining up with where things are now. Okay. So this happened a few days ago, and it's Friday right now when we recorded this. So the weekend's going to happen. The people who have not been paying attention to the news for the last 2 days are going to wake up and freak the F out and say, oh my God, the sky's falling, Chicken Little. What are we going to do? We're going to dump everything on Monday. Monday is probably going to be bad. And then Tuesday will be bad. And probably if there's a turnaround, it'll be on Tuesday. Now, I'm not saying that it's going to buy the dip and it's going to go higher and hey, put it all in black and let's let it ride. That's not what I'm saying. We are officially in a well, I don't say bear market. Technically, we're in a recession. Anything below 20% is 10% drop is a recession. 20% drops a depression. In not by market standards.
Yeah, 10% is a correction, right? Yeah, we're not talking markets.
Correction, and 20% is a bear market. Well, I actually you could come up with all these things, and they're all meaningless. The way I look at it, and this, if you know nothing about technical analysis, and we do bring up technical analysis in the show because it's important, even if you're a fundamental guy or gal, technical analysis is good for when you price it. Like, what's the trend? What's the momentum? You need to know these things. These are important. So one of the truisms that holds true for, if you do nothing else with technical, follow this. If the price is below the 200-day moving average, you should not be in the market. If the price is above, it's bullish. So I should say bullish or bearish. It's bullish if you're above the 200-day. It's bearish if you're under the 200-day. The old saying is nothing good happens under the 200-day moving average. Well, we've been under there for a while. We had an end of a quarter candle, and we had an end of a month candle a few days ago. And we're still below it, which is not good. So if you want to know anything about technical, you shouldn't be in the market right now. That's what technically it says. Now, is it a good price to get out? I don't know. I think we'll probably see a bad day Monday and probably a worse day Tuesday, but Tuesday might turn around. Because here's the other thing. The markets don't go straight down and they don't go straight up. They operate within kind of momentum. If anyone ever took trigonometry, you know about waves. Things move in waves. They go up, they go down, but the slope of the up and down is also a thing. So if it's up, if it's an up market, it goes up, it goes down, it goes up and down, but keeps going higher. In a bear market, it does the reverse. It goes up, down, but it keeps going lower. So we are going to see a point where you buy the dip and the market's going to bounce, and then it's probably going to hit a point and then it's going to keep selling off. So if that's the trend we're in, which it seems like we are, then you want to get out when you can and sit in the sidelines until it's safe. I don't know when that's going to be because I don't know what the future holds. But as I've been saying on the show the last few weeks, we're very conservative. We have been for a while, so much so that it's borderline like we'd probably get in trouble by the regulators by being so conservative. We won't, because it's the right thing to do. But the point is we're so conservative, it's crazy, because we saw this. Doug and I have been talking about this for weeks, and it's not a crazy thing to say, hey, maybe we should take chips off the table. So hopefully the listeners have been paying attention to us, because it's really important that you understand that there are times you need to do that. And the only thing that's up right now is crypto, Bitcoin and Ethereum and the VIX. Everything else is red. Actually, there's some things that are up. Bonds are up. I'll quickly go through this. Bonds are up. There's actually a retail company that's up a little bit today. I won't say the names. There's a home builder company that's up strongly today. And corn. That's pretty much it. Yeah, home builders is up a little bit. Let's see. That's pretty much it. Everything else is red today. So, we're going to share some of the charts here in a little bit and give Doug a chance to talk, because I know there's a lot to talk about with this. But I just want everybody to understand that the market doesn't always go up. I know since 2008 it has, or 2009 it has, but there are bear markets, and there are recessions, and there are bad times. And I think we had a topping pattern for the last few months, and we might be seeing a lower market for a while, and it could stay lower for a while. And this is why we said before, disconnect your political jubilation, if you're a Republican, your happiness about Trump, with the market. Just because you think Trump's going to do good things for the economy and this country doesn't mean that means a good stock market. And those of you who are of the liberal Democratic persuasion, just because you don't like Trump doesn't mean the market's going to go up or down, right? You might be celebrating the market's down. You're saying, yeah, take that, Trump, which is dumb, because that means everyone's losing money, including you, unless you're not in the market. Like the Waltz speech where he said, "Ha, Tesla is going down," even though he's like the chief. He's like head of the board of like the pension fund, and they own a lot of Tesla, and he's celebrating that, which to me is just this guy should be, taken out in the back. And anyway, I don't want to say that because
Hey, listen, I'm in Minnesota. We lost an $18 billion surplus because they found it and now it's gone in one. So if that tells you anything.
They found it. Yeah. Anyway, so I just want to make sure everyone understands these principles because, Trump could be doing the things that Trump are doing. I think are a little bit more midterm or long term beneficial. Short term, we talked about this in the show. It's going to be volatile. This year is going to be a volatile year, and you should expect this all year. Look at the first term he was in. You probably see a little bit of the same. There was some volatility. I don't know if this is short term or midterm or long term volatility, but I know the market's expensive, and I would love it to drop 50%. A, because I'm not in it, and B, because I think it's, we need to find more reasonable valuations on everything. You look at technology, look at AI is crazy overvalued. We had a few guests on recently talking about it. This is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to their show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today. Doug, what are some of your thoughts on all this stuff?
Yeah. First, I want to address a pattern here with you, Kirk. You're not in the real estate market because I believe that was overvalued, right? And now the stock market, and it's just something about conviction. What a concept. Discipline. What a concept. One thing about Kirk is, and this is really important for with the way you look at investments and money, and the way I look at it is, listen, there's no way to make a prediction. There's no way to know if you're a crystal ball. What a crystal ball! If there was such a thing as a crystal ball, we would sell that crystal ball. We wouldn't probably use it. The reality of the fact is, if you're going to be a trader and you're going to be in these markets and you're going to have investments in these markets, you need to have a plan and you have to have discipline. And sometimes that discipline is going to be right. Sometimes that discipline is going to be wrong. But the people with discipline are successful. And for those day traders out there looking at the last couple of days, I'm just going to say this. And again, I'm going to go back on my age since, Kirk started out. It's Friday. You ain't got no job and you ain't got blank to do.
I love that quote. One of my favorites. Such a good movie.
So listen, tariffs, markets, we need to separate reality from media noise. I've seen something yesterday, and I think you've got a graphic for this. It's, somebody was trying to make the point, this is like one of the 30 worst, or, 29 days, only 29 days were worse than yesterday, since 1930. Okay, you're trying to make the point that there have been 29 or 30 days that are bad. But that also made the point that if you go back on, since 1980, sorry. And if you go back on 45 years, well, that means that if I'm counting 30 days and 29 were worse than this, it means that basically 66+% of the time, we've had a day like this in any given year that's been worse than this. And not only that, you go back to 1930, and it turned out the number of days that were worse than that actually ended up being somewhere in the range of about 85% of the time. Now, we're continuing a second day, and that's obviously not, adds to the impact of what's going on right now in overall calculation. So, but was it a bad day? Absolutely. Is it a historic crash? Not even close. We didn't hit any triggers. There is some control, some orderliness in the correction. I just saw today that part of what's driving that is the hedge funds went ahead and they made, they were selling off like crazy, right? Probably in reaction to the future of the tariffs. Some of it's a lot of, taking profits. but we didn't have any circuit breakers that were triggered. What are the tariffs actually trying to do? I want to talk about that for a second. They're there to try to raise they do raise import prices. That's a fact. And it is going to, if you're going to have imports coming in, there's some people, in political people that are making comments, well, they don't have to raise price. Of course they are. The manufacturers are going to pass that on. It does disrupt supply chains, and especially in certain areas like manufacturing energy. It can slow corporate investment, and we're already seeing it. It's triggering retaliation. Part of what's happening today and the acceleration of the markets today is that China came back with their retaliation of the tariffs that were announced yesterday. But what is one of the goals that has been protected? There's a couple things out there. We've got some some charts and analysis I can get into later. But one of the goals here is they're trying to decouple from China, specifically China. Okay, you can't fully replace China at all. They're taking a sledgehammer, pretending it to be a scalpel. Okay, but you don't decouple from China from wishing it. And guess what? Nike dropped by. Nike dropped by a good.
I'll share it with you.
Yeah. There it is. 12% decline. The largest drawdown in more than 30 years. Negative 67% from its highs. Well, why did Nike fall? Because they have incredible investment in Vietnam. There is another one that's really fun. That Restoration Hardware. The CEO hadn't even been watching the stock yesterday until he was online. And he looked down in the middle of being in an interview and went, "Oh, you can read it for yourself." For those that are on here, he didn't know it went down 40% yesterday. Why? Because Restoration Hardware sells. You can call it high end, but it's high end junk. It is basically tchotchkes to renovate your house, and it all comes from across the board. But guess what? Go look at the stocks today. Nike is up today. Lululemon is up today. Restoration Hardware, I think, is also up today. Now, why are they up today? Guess what? Trump came out and said just not that long ago, we've had good negotiations with Vietnam. Right? This is hard negotiation. The whole point of this is to throw out and see what sticks to the wall. And this is something, whether you're a pro-Trump or anti-Trump, this is the reality we know. He's unfiltered. He's going to put stuff out there. It's going to spook the markets or rally the markets, and they're just following his words. Now, there's a lot of stuff that was built into that. Go back to COVID. We've talked about this before. Did COVID tank the markets? Yesterday was nowhere near what happened when COVID got announced. Did it tank the markets? Yes and no. It was the match that got lit that ignited all the fumes. It's kind of like the TWA 800. The fumes were in the tank. The spark is what set them off. Okay, the powder keg was already set, and that's exactly what's happening here. COVID, when we went into 2020, the markets were overheated. I believe, Kirk, you were talking about it then. We were already a little bit elevated, and probably 2020 was going to have a pullback. Did we expect it to go as rapidly as it did? No, because nobody realized there was going to be a pandemic. Same thing, though. We've been talking about how many things are overflated. Guess what? Trump coming out with liberation from your money day, which is liberation from China day. That's what he's really trying to say, is that basically it was the spark, and it has ignited the pullback that was effectively, already built up. It was the fumes in the tank. And what we're seeing with Nike and with Lululemon today is that the goal here is that there is going to be countries that are going to retaliate hard, like China. China feels it's in a position to go toe-to-toe. But what we're trying to do is get to a point in which there's more balance across the board between the tariffs that are already in place and use it as a negotiating tactic, because guess what this could do? This sledgehammer could effectively move and further build up relations with a country like Vietnam to get us even less dependent on a regime that has, and let's face it, Vietnam is also a communist regime, but is in a position to enforce that, to flex their muscles a little bit less, to, looking at their economy, be more willing to work with us. And if inflation, if the economy does erode, if GDP erodes, we're already seeing mortgage rates potentially erode. If these things come down, this has been stated. The United States is sitting on trillions of dollars in debt. And if they can lock in lower rates that are now higher, we have massive interest payments to start doing next year. We can lock those in lower. It's going to put put America in a much different position. Favorable, hard to say, but there's a lot at play here. And anyone who's ever been, and I'll turn it back to you, but anyone who's ever been in a negotiating room, and most Americans are not. The reality is most Americans are way too passive to deal with what the aggressiveness it takes to be in a power broker negotiating room. I have friends who are head of mergers and acquisitions for major global banks that have basically said, this is what we see every single day. But you, the public, are not used to it and could never handle it. This is what Trump does. He has no emotional connection to this, and he has no problem with throwing things out that will then shock. And then what they do is then they come back to the table and say, okay, give, and come to an agreement. That's what's going on here. But welcome. Unfortunately, your 401ks are currently part of that negotiating table. And so is it a long-term impact to you? There's going to be some change and some disruption, but the reality of it is we're right in the middle of that negotiation, and it's going to get ugly before it gets better.
Yeah, and I think it's great, Doug. I appreciate you kind of sharing that perspective. I think it's important. I think this isn't new to people. We had 4 years of Trump, and unfortunately the whole time the Democrats just crapped all over him, so he didn't get as much done. But people know by now, like, what to expect from him. He's a negotiator. That's what he does. The whole world knows. There's no secret. So the thing that I always find puzzling is, and this has been thoroughly disproven, by the way, but if you think about the markets, right, because people are here because they want to know about their investments. And if you think about the markets, they should be efficient. All information is known by everybody. Well, if that's the case, how did 2008 happen? If that's the case, why did 2022, was it 22 we had bad market? Yeah, it's 22.
Yeah,
right?
22 with the interest rates.
So 22, when interest rates went through the roof, and all assets virtually went down. Everyone knew prior to January. They started going down January 2nd. Everyone knew December 31st, but people weren't selling. It was like, close to all-time highs. And yet January 2nd, people decide to sell indiscriminately like crazy. And so, I see stuff like this, and it makes me kind of wonder, like, the markets are mainly run by institutions, not individuals. But you see something like the tariffs. Why the heck did people wait until Trump came out? Because literally, if you see the markets right before he announced, everything was fine. And then after they announced, like right after, the markets just plummeted. And now I think we're down 15 and change % for the year as of some point in time today. I don't know what it is this second, but earlier today it was about 15% down. Maybe it's more. But the point is like, why do people wait? Like, institutions, I get it. They're making bets on what he's going to say. But who thought he was going to say, oh, we're not going to tariff people? Who thought that? I mean, it was no secret. Doug and I are sitting here saying, yeah, I just wonder how much they're going to start with. It's negotiation 101, right? If you want to understand negotiation, for those of you who think that, well, it's uncouth for what Trump's doing. Oh, it's not nice. I want everyone to like us. I get it, right? But here's the thing. If you're negotiating, there's an art to negotiating, and Trump is one of the best ones around at it, right? He has to be. New York, real estate. I mean, you have to have a brass set on you to do that kind of work. So what do? You come in, you shake the box. You come in and you say, all right, we're going to do this. We're going to do this. We're going to do this. And you start creating all these scenarios from scratch. And now when you go to negotiate, you're like, well, I got this 20% tariff. I don't know what we're going to do about that. Oh, we'd love to have that removed. Okay, well, we're going to have that removed, but we really want this other thing removed on your side. Okay, we'll make a deal. Well, Trump created that from scratch. It didn't exist. He put it there, and now it's a negotiation tool. Now he can take it away, right? And maybe there's some other things that he does. He does this all the time. It's his style. And once you understand what he's doing, it's really clear to see, okay, he's going to shake the box, which Doug and I have been talking about. We know he was going to shake the box. We didn't know how it was going to be. We didn't know what the result would be, but we knew he was going to do something, because if he didn't do something, then why would anybody bother negotiating with him? So he did something. It's hard, and now everyone's coming to the table. Now, the two countries that came to the table early were Israel and who was the other one? Was it Australia? There was I'm drawing a blank on. Anyway, Israel was one of the first countries to come to the table prior to the tariffs and say, "Let's work this out. We'll get rid of our tariffs on you." I didn't even realize Israel had tariffs on us, but apparently they got rid of theirs and we got rid of ours prior to them going through. Okay, so they took them off the board. And there's one other country, I forget which one it was, but anyway, so two people beforehand, and that's a smart move. All right, remove us from the equation. Like we don't want to have this fight. Now everyone else has got to do this. So you could love or hate Trump, doesn't really matter. He's the president. He's going to do what he's going to do. But I do think we can predict future volatility, future disruptions. I'm going to share a few things right here. I'll give it back to Doug. So some interesting charts I found, which I wanted to share. One of them is gold. So I know it's not the first thing people are talking about. People want to hear about the market, but think about gold in this way. When you're looking at gold, you should be looking at gold in all currencies, not just the dollar. The dollar is the only one that matters to you. But if you want to know if gold is in a bull market, here's how you tell. And I've got one of these similar kind of filters on my computer as well, where I'm looking at this and I'm looking at, are we in a bull market? Well, yes, we are, because the Aussie dollar, the Swiss franc, the euro, the yen, all the major currencies are going up in terms of gold. And the top one is in terms of US dollar. So if everything's going up in gold terms, it means gold is appreciating. Now, if it's going down, it means gold's depreciating in value. Because in any sort of trade, you are trading one thing for another thing. Now, if you're buying a stock, you're trading cash for the stock. If you're selling it, you're trading your stock for cash. There's always some comparison. Stocks are priced in US dollars. They're not priced in yen. They're not priced in tiddlywinks. They're priced in dollars. So if you look at a stock, it's priced in dollars. If you look at a stock priced in Canadian dollars or the yen, it's going to have a different price to it, because what you're doing is you're exchanging a certain amount of that other thing for the stock. So for gold, it's really healthy to look at gold in terms of other currencies, because everyone has to pay that to buy gold. Now, if you notice, gold's been going up for a while. It means that everyone across the world is valuing gold more, so they're willing to pay more subsequently each day as gold appreciates. Now, there's a lot of institutions. We had Dan Rasmussen on recently. We were talking about this. A lot of institutions are buying gold. A lot of governments are buying gold. Unfortunately, not a lot of individuals. No one's even talking about gold. So if you want to know like where the secret bull market is in the middle of this chaos, it's gold. And it's not, I mean, gold's down today, just to be clear. It's not like gold's up, everything else is down. No, gold's down. But that doesn't matter. If you look at 2008, everything was down like 58.5% approximately. You know what was up for the year? Cash and gold. That was it. Nothing else was up in 2008. So even though gold went down, so in the fall, in like October, in that period where the whole world was falling apart, gold dropped, but it ended up the year up. It's kind of like in COVID. When COVID, the markets dropped like 35%, and yet they were up like 18% for the year. Like I still can't believe that happened. But anyway, the point being is it rebounded, right? And the market's rebounded because of the Fed. The Fed said, we're going to buy everything, including your baseball cards if we need to. So they just said, we're going to support the markets.
That's why baseball cards went up in value finally for the first time in 30 years.
Right.
I finally figured it out.
The Fed has a good collection. So anyway, so the point being is you need to be thinking about what is your thing that you're looking at compared to. So gold in that case. Let's see, other news. Newsmax went public, was up 2,000% in like a few days, and now it went from 265 down to like $50, which I find funny. But All right, here's some other things. So we had, let's see, I'm trying to find some. All right, so I want to share today's what we're looking at.
Can I say something really quickly?
Yeah.
Just a reminder to people that I know IPOs, and get asked this a lot. They want to be on IPOs. IPOs are the shiny new product, right? And it's what the investment banks bank on this. They sit there and they get all of their high net worth investors to get the special opportunity to get in this IPO. The majority of IPOs actually end up not performing very well and going down after they're released, after that short spike. So just to remember, those of you feel like, well, the little guy can't get on it, be grateful, because it's usually not, you're usually better getting the investment later. Facebook was a perfect example. It has taken off, and it took like a year before it really started to take off to where it's at today. So just wanted to touch on that.
Yeah, agreed. It's that quick bump that people are cashing out. And here's a principle I heard years ago, and I thought it was really sound, which is, we see a lot of IPOs everyone wants a part of. I get calls all the time. How do I get a part of SpaceX? How do I get a part of, this IPO? How do I get a part of this? You don't want to be a part of that stuff. You don't. You absolutely do not want to be a part of it. And here's
illiquid, high risk.
Well, no. Here's the reason. If I have a company, let's say I've got, ABC Corp, and I'm making widgets, and it's the best widgets around, and, we're going public. And why would I ever take my company public? It's because I can make a crap ton of money quickly by cashing out my shares. So if I own 100%, so let's say Doug and I own a company together, 50-50, right? And we sell it for it goes public, it's worth $1 trillion, and we're going to sell like 10% of it, right? So we're going to sell $1 billion of shares to the public. People buy it up, they love it. Why am I going to do that? It's because stupid investors are willing to overpay for it. So why wouldn't I sell it? I mean, Doug and I run companies, and I'm running my company. And if somebody's willing to overpay obnoxiously, I'll sell today. And for those of you M&A people and private equity who are trying to roll up financial advisor firms, I will pay you. If you pay my price, I will sell out today. Now, you're not going to like my price. It's going to be very, very high. But I do have a price. Everyone's got one, right?
And to the rest of you listening, if that happens, welcome to Money Tree Podcast, hosted by Douglas Hagren, because Kirk won't show up next Friday.
I'll be on my own island, Doug, at that point. So. It'll be a non-disclosed location, so nobody can come visit me.
Yeah, I'm his succession plan if that ever happens.
So anyway, so the point being is, when companies go public, it's because somebody is willing to pay some obnoxious price. There's no reason to go public, and there's actually a trend of companies just not going public, because why bother? I don't want to have to deal with the regulatory stuff, the oversight, the people. I got to report every quarter. No, there's a reason I have a private company. Well, one, because we're too small to go public, but I could go public if I wanted. But really the reason is because I don't want to have to adhere to stupid rules that the markets require. And they're not bad rules, but if I'm running a company, I don't want to adhere to that. I want to do what I want to do. I don't want to have to pay auditors come in every quarter. I got to pay to keep myself in compliance with 5 million regulatory things that, what was that thing that they required everybody to do after the tech crash? It was Sarbanes-Oxley. Yeah, that stupid thing. It just hamstrung so many companies, but it didn't do a darn thing. It didn't protect anybody. Anyway, this happens all the time. And so the point being is, if you want an IPO, it means you're overpaying. Don't do it.
Yeah, now, Musk may want to hear your voice on X. He doesn't want to hear from investment companies on the performance of X.
Yeah, well, look, perfect example. Great example, Doug. He could have bought X and just bought a majority share, and he would have had to deal with all the wankers out there. They're yelling and screaming every day. Well, you got to do this. You're not this. You didn't hire these people, and it's not diverse enough, and all the crap that people say. Nope, he bought it out, takes it private. Nobody can say a damn thing to him. Good luck to you. The most you can do is just unsubscribe from X. That's it. Otherwise, no one wants to hear from you. And so that's the truth, right? Is that there's value in keeping it private. Now, if you want to cash out and you decided I made a ton of money and I want to put it all in the bank, Then you cash out. You go public, you merge, you get bought out, all the stuff that people do. That's how you make the most money for your business. So anyway, we don't have to go down that rabbit hole too much, but I did want to share this chart of what's going on in the markets today. This is today. Yesterday was just as bad, if not worse. What are the areas that are doing okay? Well, home improvement. We got Lowe's and Home Depot are positive. Nike and is it Deckers? They're positive. Residential construction's positive. And what's this one here? Orly, I don't know. Anyway, there's a few there. Lululemon's positive. There aren't many. If I'm counting here, there's 1, 2, 3, barely 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16.
And a lot of those are tied to the Vietnam conversation. So
16 companies out of 500 are positive today. And as Doug says, yes, most of us due to Trump's comments. And I'm sure he'll make more comments over the weekend, positive or negative. But just look at this disaster. It looks like a medieval battlefield at dusk. It's blood everywhere. And that's what it was like yesterday. It may even be like that next week. If you don't have the stomach for it, then you should have listened to us earlier. And, it's just the way it is. But I do want to share a few things because I don't want to rub it in because no one wants to hear that. Let's see. So where the heck is the performance? I was trying to share this before. Okay, here's futures. Here's futures today. VIX up close to 19%. 30-year bonds, 10-year bonds, 2-year bonds. The bonds are doing well.
But not much. Bonds are not really jumping the way we've historically seen bonds jump against market, which tells you a lot about the problems that are still exist in the fixed income world.
But the bonds don't typically jump that much, just to be clear. Bonds don't go up like 5% when the S&P goes down 5%. That's not really how
that is true. That is true.
They're much more conservative. And bonds, so if you looked at 2022, bonds went crazy because interest rates are going crazy. Interest rates are not going crazy right now. There's a suspicion that interest rates will drop because the markets drop. That's why bonds are going up. So it's just kind of like, chicken or egg problem. Anyway, corn's up a little bit. The dollar's up. It actually tanked for like the last few months, if you can see here. It's gone down from like 110 down to like, close to, I don't know if it hit 100, but 101 anyway. So now we're close to 102. So, it's come down a lot. The reality is that if you're looking at this, there's not many places to hide. Actually, cocoa was up the last few days. Now it's down again. That's had a market of its own. Gold's down, all these things. You look at crypto. Look at crypto. Woohoo! There's celebration right here. You got, I'm not saying you should put all your money in crypto, but you're having a nice day if you have some. That's all I'm going to say.
Oh, that's very bullish for crypto. We were talking about this earlier because, and we'll see if it sustains, but if you look at where crypto has been the last couple of years, it's been exceptionally correlated to liquidity. It's also been exceptionally correlated to tech. What you're not seeing today is as tech is getting obliterated. I mean, Amazon doing a nice whopping -6, and Apple down -6, and Google actually holding pretty well at -2. If we were following and the liquidity being sucked out because of markets, if we were following the patterns, crypto should be down today, and it was yesterday. The fact that it's bounced back up at least is a slightly bullish indicator. We'll see if the pattern remains.
So one more quick thing, and I'll move back to Doug. So what we're seeing here is mass liquidation. So this is the S&P 500, which we talked about. Here's the world. The whole world is experiencing liquidation. China, some of the biggest stocks, double digits. I mean, Alibaba's down 12. I don't know all these things. JD is down 10%. Baidu's down 10. Some of the bigger ones, I don't know them all, but down 10. In India's down reasonable amount. Taiwan, obviously, Japan, like United Kingdom, everywhere. Everything's down. Now, Europe was going through a bullish trend, and they're getting sideswiped. Now, the reason we have not invested in Europe is because of this. I've been doing this long enough to know that when the U.S. catches a cold, the whole world sneezes. So it doesn't mean that there aren't bullish tendencies in other parts of the world. It just means when we're going through a mass liquidation, people liquidate everything. They don't care where it is, what it is. They're liquidating, and they're asked questions later. So Here's the thing to keep in mind. If we're still in a bull market, this is a great time to look around for bargains. We're not there yet. I'm sitting in cash. I'm not even looking at the screen. I'm only looking at the screen today because I'm doing this show with Doug. But I wasn't looking at the screen this morning. I looked at it once. I'm like, yeah, whatever. It's not done yet. Like you don't have two like negative 5% days in a row and you're like, oh, that was it. No, that's not how it works. So you see patterns in the market. You've seen it once, you've seen it again, which is why my prediction of it bouncing on Tuesday is because based on historical precedents. And if this happens, you're going to see me all on social media bragging about how awesome and right I was because I'm so smart. And I'm just telling, and that won't be, I won't have this clip, which is, yeah, I could be wrong, right? And it's a guess based on other patterns. But the reality is look at this. So we didn't invest in international because I knew when we sell off, everybody liquidates. They're just trying to free up cash because they don't know where the bottom is. That's smart on the institutional world. The institutional world takes them weeks to liquidate. They can't do it really quickly. So, if you notice the VIX got really expensive. I don't have that. Oh, here it is. You see the VIX? The VIX, look at this. So I want to share this and then I'll move it to Doug. If you look at the VIX historically, you go back months. Okay, well, I guess this is as far back as it goes. So, right now, so like 20 is a barrier, right, on the VIX. It's hit that a bunch of times and bounced back, but these weren't significant events. What happened? Sorry, I hit the wrong one. 30. Yeah, that's a little bit more accurate. So 30 and 20 is the range where you want to start like selling options premium between 20 and 30. Above 30, you're awesome. You're doing great. So if you look at COVID, it hit, I think it was an all-time high. I'm not 100% sure, but I think 80 was the all-time high. Although what did it hit high? 80, almost 81. But I remember that day because I was looking at it and like, wow, could it go higher? And of course it didn't. But if you look here, like after that, it got crazy because people didn't know what was going on with COVID and Trump and all that stuff. And then it went back to a low VIX like it normally was. But we're hitting 30. That's a really high number historically from the middle of nowhere. Like if you look at this spike, you look at these spikes, this is because of COVID. So I kind of discount this. It's not normally like this. If you take this down like 10 points, that's normal. And you see a spike here or there, like this thing. This was actually during Trump's event in Pennsylvania. I'm not going to say it because I don't want to get dinged or followed or whatever. But this is the thing happened to Trump in Pennsylvania. Like that was the spike. So you see these things, they typically don't last. They go up, then they go down. They don't last. So I could see this having another day or two and then coming back down. That would be reasonable. Now, if you expect a bear market, what you would see is you would see maybe a generally elevated plane like this, but without the spikes. So unfortunately, this doesn't go back to like 2008. I wish it did. I'll see if I can pull that in a bit. But if you go back there, you'll notice like the early 2000s, you see a downward slope of the market. The VIX doesn't take off because it's a trend. It's like when the market trends up or trends down, it's a trend. So you don't get the volatility. The volatility comes from, holy crap, I didn't expect this. Let me dump my whole position today. And oh my God, I got to buy, or this is actually what happens. Oh my God, I'm freaking out. It's going to take me a month to sell my positions. Let me go buy puts to protect myself. That's what happens. And that buying the puts spikes the VIX, and that's what caused it. Well, eventually people have all the puts, then the VIX goes back down. So just be aware, like all these things are interrelated. And there's not really a cause and effect necessarily, although what I just said generally is. Mostly it's correlations. So I don't know. What are your thoughts here, Doug?
Well, I'll stay on the VIX for just a second because, it's a big question here. Is it a weapon or, when is it a weapon versus a wasted hedge? And the reality is, again, it's measuring the 30-day stock market volatility. It's the fear gauge. It has to do with the Chicago Board of Exchange and people putting on, options. Right now, so generally speaking, whenever the VIX spikes beyond 35 to 40, and whenever the news starts looking apocalyptic, in other words, everyone's panicking, we're probably already starting to be at the beginning of the end of the VIX spike. Right, it's generally going to go before that. Now, COVID crash. Again, it blew 80 plus, but
Didn't
the
stay there.
yeah, no, exactly. Yep, it blew 80 plus. The 2008 crisis, it actually spiked to 89.
Okay.
But
That's
so
different.
yeah,
The
very,
whole
very,
world
very,
was ending.
absolutely, very, very different. You talk about Europe, and I think another reason that Europe is a tough place to invest is there's historically been a real lack. We've talked about this before, but a real lack of investment in Europe. It is still very much. I mean, it's not the Middle East, okay, but it is not a continent that has spent a lot of time trying to really embrace the future, right? If you look at a lot of what Europe has gone through, even its conflicts, a lot of those conflicts have been built around trying to maintain traditional values. And when you're looking at traditional values, just like the Middle East, and you're looking at traditional values as something that is a core resistance, you do not want to leave, it typically does not make you a great place for future innovation. Why is it that, Asia has become and exploded on the economic scale? Is because even though they do have a lot of traditional, they have exceptionally embraced technology, innovation. They've ignored a lot of tradition to get there. Europe still struggles with that. And I think that's something that they will, and again, a lot of their citizens still live kind of off of this laissez-faire attitude. And not that there is an incredible amount of business savviness that comes out of it. It does tend to be concentrated in certain areas. Germany certainly embraced that for a long time. But you look at the regulations that they impose on development enhancement, it's a lot of like what's going on in California. And California, although it has a lot of companies, you look at things like, the regulations that even Bill Maher was talking about in the last week when he sat down with the governor and said, hey, why is it's taken me 2 years just to get my roof fixed, right? Because I can't get anything done. Now, do they get things done? Absolutely. But it takes a long time to get there. And Europe is extremely slow about welcoming change because they are very cautious in how they overcome regulations and tradition. And I think that's always made it a difficult place to invest, not an impossible place to invest, for sure. I want to kind of reiterate and highlight, just as we kind of close this out, what is going on right now. And I've kind of talked about this a little bit, but I want to come back to it. This is really taking a sledgehammer to a very risky, long-term, extending long-term relationship with China. Okay, China, and what are some of the things that are real from this? Well, first of all, it is absolutely a fact. You can look at the data. People are going to tell you that that they're countering the fact that the United States has been in an unfair tariff scenario. There is data from the WTO, the World Bank, JP Morgan, etc., that show that there has absolutely been an incredible amount of tariffs applied to the U.S. versus applied by the U.S. And there's a reciprocity line that the tariffs applied by the U.S. have been well below 4 to 6%, most of which has been between 2 to 4 or below, where when you look at what's been applied to us, it has predominantly been very heavily between, in that 4 to 6% and above. As many countries have been hitting us with 6 to 8 to 10. Many countries are out there 12 to 14%. So that part has not been fair. And they're trying to really work on, whether or not it's going to be effective or not, work on, making that to where there's going from a negotiating standpoint, you can't bully us unless you expect to get this back. Now, this is like real estate, and is it a buyer's market or seller's market? Kirk, you made a point there about investing in Europe again, about, the fact that it's been, tied, it's been really tied to the global economy, and a lot of tied to art. When we're not doing well, neither does international a lot of times. And this is kind of like the real estate market. Look, if you're in a buyer's market, if you believe it's in a buyer's market, and you sit there and say, I know if I throw out a really high price, and you said this about somebody buying your investment company, right? Somebody wants to throw out this high price, how much do I really want to sell? Well, if somebody's willing to pay it, they're going to come to the table. It's kind of the philosophy that's going in tariffs right now. It's like, look, is it, are we throwing out something that's extremely shocking? Absolutely. And if the entire world says no to it, we are in a really tough position, right? Because we've created this war. But what is he banking on? He's banking on there's going to be some buyer that's going to come along and say, yeah, we really can't. We're going to give in. And who is that? Vietnam, India, Malaysia, shifting those supply chains and pushing it over there so that we can reduce the dependency on China. And there's going to be pain beyond that. But he's hoping, and they already did, supposedly, at least on communications today, they've already come out and started to say, okay, this hurts. He's banking on countries to say this hurts enough that we're going to come down. And what does that do? It forces other countries to have to come down as well or be left behind. And that's really hard to do when you're looking at someone like China, who is big enough to sit there and say, we have enough money and power that that we're not going to give, that these negotiations are going to be really, really heated. And there is a lot of industries, potentially pharma, rare earth tech, that are extremely intertwined in China, that severing it quickly is just not possible. And guess what? So you're going to find that from this, we're probably going to see selective areas that are going to continue to really, really struggle if these go into place. But there's going to be other areas that are going to more quickly and more rapidly be the new places to invest that are still going to be okay. They're going to be okay because they're going to be able to move more quickly. So, expect volatility. Here's the thing. Donald Trump was in Home Alone 2. He's a showman. He's been a showman. Art of the Deal, his book, was a showman's book. The Apprentice, a showman. So guess what? Not only is he a hard negotiator, he's a showman. So expect every part of this negotiation to be laid out there for public consumption. And that's just something the markets just don't like. So I'm going to wrap this up and then head it back to you, Kirk. Listen, those who have been listening, my company, Emergent College Advisors, and this is a company that, really in a world of volatility, it's normal. Economic shocks, just like now, can come faster than ever. Protecting your family's future demands more than hope is going to need a strategy. And that's nowhere more obvious than college planning for successful families. Families who've built real momentum, the ones who are told they make too much for help, but they're still going to face rising six-figure costs. That's going to erode savings, investments, and opportunities if handled wrong. So we focus on helping affluent families defend what you've earned. Okay? We've helped focus on controlling college costs with precision and designing wealth transfers that are going to survive inflation, taxation, markets, uncertainty. Because having the most to lose isn't the problem. Leaving it exposed is. And so smart planning for smart money families, that's those that refuse to leave their future to chance. And if that's important to you, go to check out our website, Mergent College Advisors, MERGENT, mergentcollegeadvisors.com. Learn a little bit more.
Awesome. Well, thanks, Doug. And we'll wrap it up here. I know people have better things to do, like selling their entire portfolios. Anyway, I hope everyone, I hope we have a better next week. I know people, it's not a laughing matter, people losing money, and I know people are upset. So just try to keep a cool head through all this. We tried to lay out what our thoughts were and where we think things are going with all this. Obviously, we don't know, but I've been in this show long enough to know when it's time to hold them and when it's time to fold them, which is why we were telling you the last few weeks
to hold them.
Yeah, we need that background music. I got to get that app on this on Restream. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.